The important relationship between equities and rates is a function of the speed of the backup or the increase or decrease, because it kind of is there's a symmetry to this, but the speed and the magnitude of the change in interest rates. So very specifically, if we think about changes, modest changes in the 10-year Treasury yield, for example, not necessarily have a huge impact on equity prices. However, once you get a move that in sort of statistical terms around 2 standard deviation move, that's usually a tipping point. So let's put that in terms for current investors. A 2 standard deviation move in 1 month, 10-year U.S. Treasury volatility is around 37 basis points. That is to say that if the 10-year Treasury yield rises by around that level, by that magnitude in a month, that would be a highly unusual or very significant move in the market, and that would be typically associated with a decline in equity prices. And of course, that is what we saw last week, first week of the year, dramatic increase in rates over not just in the 1 week, if you want to isolate that just to say 5-day trading period, but even over the past month. That magnitude of increase is quite significant, and that's pretty much hit that threshold. And so that would be consistent with what we've seen in a decline in equity prices. Now, very specifically, the single greatest mispricing in the U.S. equity market is between companies that have high expected revenue growth, but low or negative margins. On the other hand, high growth companies with positive or very significantly positive profit margins. That gap is adjusted dramatically in the last year. Put some numbers around that. High growth, low margin stocks traded at 16 times enterprise value to sales February of 2021. 11 months later, they're trading at 7 times. So a huge derating that took place. Much of that took place in the last month or so. And largely that's because as rates increase, the valuation or the value of that future cash flows are worth somewhat less in a higher rate environment. And that's a big issue. And so the gap between those two, I'd say, is the single biggest topic of conversation with clients. You've had a huge derating of the fast expected revenue growth companies that have low margins. And the argument is probably that there's more to go in that readjustment. The relationship between these two categories, these two buckets of stocks, are still pretty close to one another, and probably should be wider. And that could go different directions. It could be that some of the companies that have fast growth and also high profit margins increase in their valuation, or perhaps lower prices for some of the others which have negative profit margins. So that comes down to the relationship between rates and equities, broadly speaking, the speed and the magnitude of the change, and also very specifically about the idea of profit margins being such a key topic of fund managers. And that's so important in the rate change environment we're experiencing right now.
David, when it comes to the tech giants, they have been a huge driver of U.S. stock returns. And last week we did see somewhat of a pullback. You had Microsoft shares trade down about 6% on the week. But if you look at how far they've run since pre-pandemic, we're still up 90% in some cases. So if we do see them take a turn for the worse with the Federal Reserve raising rates, what kind of sell-off should we be thinking about? Where is the floor for some of these tech majors?
We can see some context around, say, what happened 20 years ago when you had a narrow breadth market, which is what we had in 2021, when you relatively few number of companies driving the index, lifting the index to record levels. 20 years ago, it was a diminution or a reduction in the growth rates on the top line revenue that was a source, not the only source, but a source of the dramatic decline in equity prices. Valuations were extremely stretched, but also the expectations of revenue growth did not end up being materialized. Put some specifics around that. The expectation in March of 2000, as an example, was that the largest companies in the market would generate revenue growth of around 16% annualized over the subsequent few years. It ended up being positive 8%. So it wasn't like it was nothing, but it was not what was anticipated. And so right now, if we think about some of these largest companies in the market, they are forecast to have revenue growth annualized over the next couple of years of around 17%. Put that in context, the rest of the market around 5%. So you got much faster expected growth over the next couple of years. To the extent that those companies can be delivering on that increased revenue growth, that's likely to be supportive of the equity prices. You've had some repricing already that's taken place, and clearly the level of rates is going to have a significant impact on that. As we just talked about a moment ago, our forecast at Goldman Sachs, my colleagues in interest rate strategy, anticipating 10-year U.S. Treasury yields will climb to around 2% at the end of 2022. So only modestly kind of above this level over the course of the entire year. And to the extent that that's the case, some of the larger companies that are both growing rapidly and have high profit margins likely to be among the better performer stocks in the market. And those would largely be in technology, although not only in technology. We have also some of the companies in financials that should be benefiting from a higher interest rate environment. Some of the banks in particular, better net interest margins would be a driver of that. The economy is still growing. And third would be some of the value opportunities in healthcare. Healthcare as a sector trading right now at the lowest relative valuation versus the market in almost 30 years. The relative valuation we are trading at in healthcare today is similar to the levels in 1994, 2010, at the height of the debate around the Obamacare proposals. And we're back at these kind of relative valuation discounts versus the market. So the opportunity set in the highest growth companies is going to be those that are also profitable. That's a key variable. We talked about that just a minute ago, that margins are a key debate and area of focus for fund managers in 2022. The second is the rate environment. Financials will be beneficiaries of higher rates. Historically, they're the most sensitive to changes in the rate environment. And the third is in terms of where do we find some value in a broadly speaking market that's not offering that much value. S&P 500 trades at 22 times forward earnings, maybe 21, depending on the day we're talking about, but basically pretty high level of absolute valuation. Interest rates itself, very low. So historically speaking, the kind of relative valuation of equities versus bonds are still somewhat below average. And I think that's a key aspect where we drive money flow and where the source of demand will be for 2022.